Okay. And may I just get the confirmation? Are you able to hear me?
Yes.
Okay. All right. So can you hear me?
Yes.
Yeah. Okay. All right. Thank you. We continue from where we ended last time. So here is the financial. Here is the trial balance that was extracted from the book of this particular business as of 28 February 2017, and you have this trial balance here. Oh, you have this trial balance. This is the trial balance, and so from this trial balance, there are the following adjustments that you needed to make. After making these adjustments, then you draw up the trading and profit and loss account. Then you should be able to show the balance sheet as on 28 February 2017. So the first thing that we are going to be starting with always is to identify the positions of the following, whether the following elements on the trial balance, whether they go on the trial balance or they don't go on the trial balance, where do they really go? So that's the most important thing that you need to get. So let's start with let me use the red marker. With the purchases. The purchases, where do they go? Do they go in the trading account or the balance sheet or the PL? From the formats that we talked about last time, the purchases, they go in the trading account.
Loss account.
Yes, then the sales, they go in the trading account. The cash at bank and cash in the hand, and the capital, they all go in the balance sheet. BS, the drawings go in the balance sheet. Office furniture goes in the balance sheet. Then rent, wages, and discounts allowed. Discounts allowed, not discounts received. They go in the what? Where do they go? They're expenses, right?
Yes.
These are expenses. They go in the profit and loss account, PL, and the debtors and the creditors, they go in the balance sheet, DS. Then the provision for doubtful debt, it is going in the profit and loss account. The delivery van, it is an asset, it's a fixed asset, it goes in the balance sheet. Then the van running costs, where do the costs go? Are they not expenses? Profit and loss account. Then the bad debt is an expense, goes in the what? In the profit and loss account. So once you're done doing this, marking this, then you have known their positions, where they are supposed to go. So it's easy to continue from here. So now here is what happens. When you go to the notes, these are the adjustments that you're supposed to make to these entries, okay? So the most important adjustment that you always have to start with are the adjustments that are found in the trading account. That is the adjustments on the stock, the adjustments on the purchases, and those adjustments on the provision for doubtful debts. I'll highlight more on that one you get it. So I'm saying you need to make sure that you make the adjustments that involve the trading account. The trading account always ends on the gross profit. It ends on the gross profit. Once you, just before expenses, you have the trading account upward. Okay. From expenses going down up to the net profit, you have the profit and loss account. Then the balance sheet comes afterwards. So now, when you look at the stock on the 28th February, this one, it is the closing what? It's a closing stock because you're drawing up the trading and profit loss account on this particular day. So the stock on that day is 2,400 quarters. So this one is a closing stock. That's what we are going to write under closing stock when we start writing the closing stock. Then what else do you have? You have to check you have to go to the provision for doubtful debt. Why should you go to the provision for doubtful debt? You have to check is the provision for doubtful debt increasing or decreasing? That's very important. Because if the provision for doubtful debt is increasing, then that is an expense. It goes in the what? In the profit and loss account. But if the provision for doubtful debt, get this one clear. If the provision for doubtful debt is decreasing or has decreased, it means that one is a gain. So you will add to the what? To the income, to other income. You're going to add this one. It goes to the other income, just like a commission received, rent received, you will add there. The other entry that you can make, or the corresponding entry instead of this one, you can subtract it from the expenses. So it's not an expense once provision for doubtful debt has decreased. So that's why it is important to come and analyze this one. So you find that according to what we have been given, we have been told that the provision for doubtful debt has what? Has increased. So therefore, since it has increased, it remains in the profit and loss what? And loss account. So there isn't much thing that you are doing from there. So what do we have now? Then you come you come to depreciation. Now let's do the profit and loss account, having analyzed the positions of the following. Then I'll show you how to make these adjustments. Commenting on the following adjustments now. Let me pass a comment on the adjustments that you are making. Once you have accrued expenses like wages and salaries, these are accrued. Accrued expenses are added, okay? Accrued expenses, they have to be added to the respective expenses. So if they are for wages, it means this amount named as accrued wages and salaries should be added to wages and salaries, right? Wages and salaries is 31,400, right? So you will add this what? 340. When you record the wages and salaries under expenses, you have to add this amount. Accrued wages are added to the expenses, not accrued wages, accrued expenses. Then the prepayment, we have the prepayment for rent here. Prepayments are subtracted, okay? So prepayments are what? Are subtracted. You subtract the prepayment, subtract the prepayment. You make sure that you subtract the prepayment. So for example here, rent has been prepaid. So we have a prepayment of the rent. So you go on the rent. Where is the amount for rent? The amount for rent. So the amount for rent that we have here is 3,000 and what? And 400. Then you will subtract what are you subtracting? The prepaid amount, which is 200 and what? And 30. You subtract that one. Then the answer, that is what you're going to write under rent. Okay, because of the prepayment. Well, van running cost owing, adjustment number D. Van running cost owing. So these are more like, you treat them like accrued expenses. So what you do, on the van running cost, you're going to add this amount, 72 quarter. Let's use quarters. So on van running cost, you have this amount that is under van running cost, and it's how much? How much is it? Should be 615. So you will add the 615 plus what? Plus 72. That is what we will record under van running cost because of these expenses, this cost owing. Okay, these costs, they have been incurred, but you haven't paid for them first. Then I've already commented under provision for doubtful debt or allowance for receivables. Yeah, I'll show you other examples where you have percentages where you need to calculate. But for this one, it's direct. You are just told that it's an increase. If they say it's a decrease, please, that decrease, okay, should be what? Should be added to the income as added income, because it's a decrease in provision for doubtful debt. Then the depreciation now. How do you make adjustments under depreciation or around depreciation? So you are told that office furniture has got the depreciation of 380. So this is the depreciation that occurred within the period. So it's an expense. That is what you're just going to record. Okay. Yeah, I will show you the other example where you need to calculate. This one, there is no need of calculating. It's just said. And also this one, the van running cost. The van running cost, delivery van depreciation is 1,250. So it's also an expense. So you record that as an expense for depreciation of delivery van. So these are expenses, and you will subtract them. Then from there, Nishi, you are done. So let's come up with the profit and loss account. Let's start from the format that we just said last time. What do we start with? We always start with what? With the sales. Okay. We start with the sales. And how much are our sales? Our sales is 15,7,165. Then after sales, you check, do you have sales return? Okay. If you have sales return, you will subtract from these sales. But since we don't have sales return, isn't it? Since we don't have sales return, what we're going to do is to go to less the cost of what? Less the cost of goods. Let's see cost of goods. Less cost of goods. Now, under the cost of goods, the following are the things that you have. You have what? You have to check the opening stock. Okay. I said that you always start with opening what? If you have, we have this stock on March 2016 as the what? The opening stock. So you have the opening stock. Opening what? Stock. How much is your opening stock? Your opening stock is 4,120. Okay. 4,120. 4,100 and what? And 20. Anyway, the solution is already there. Don't panic about writing. I will send these notes to you. Yeah. Just follow. I'll send the notes to you. So 100 and what? And 20 is the opening stock. So to opening stock, you add what? What are you adding? The purchases, right? You add the purchases. And what are the purchases? 92,800. 92,800, like this. So you sum like that. Okay, I'm just showing you the draft. There is already a solution so that you understand once it comes. So you add the purchases. Once you add the purchases, you sum like this. Then you check, do you have the purchases returned? Okay. Do we have the purchases returned? If you have purchases returned, you subtract. You less what? Purchases returned, just as we said last time. You less purchases returned. But if you don't have the purchases returned, you will not. You have to proceed and check. Do you have the carriage inward? Because carriage inward is added to this. So if you have carriage inward, you add what? Carriage what? Carriage inward. Right. After adding carriage inward, you less. What are you going to less now? You will less the closing stock. This stock which you said here, the stock on 28 February. So closing stock. That's the match that you're going to do at right, which is 2,000 what? 400. Then the total sum that you remain with now is called the total stock cost of goods. Okay, it's the total cost of goods. So the total cost of goods should be subtracted from the what? From the sales to make the gross what? The gross profit. Yeah, that is how you do it. You subtract, then you make the gross what? The gross profit. So let me show you now what you're supposed to do. So what are you supposed to do? So this is what is expected of you. This is the same thing that I was talking about. Okay, this is the solution. So I said that always you start with what? The sales of what? The sales. From the sales, if you have sales return or returns inward, okay, you subtract here to make what? Net sales. But since you don't have, you just proceed and you will less the cost of what? Cost of goods. Under the cost of goods, you have opening what? Opening stock. From the opening stock, you will add what? Purchases like this. Okay. You have purchases. Once you add purchases, you check, do I have purchases return or returns outward? Okay. Returns outward. You don't have returns outward. Since you don't have returns outward, you will just proceed like this. Then you check, do I have the carriage inward? If you have carriage inward, you should be, it has to be added. You should add it. Yeah. Then after adding it, you should less the what? The closing stock. This is the amount that you are listing, the closing stock, which we said it is 2,400. This will be called the total cost of what? Goods. Okay. It will be called the total cost of goods. The total cost of goods should be subtracted from these sales to give us this 62,642 as the gross profit. Right? So what we have now is the gross what? Is the gross profit. So you have this gross profit. Once you have the gross profit, you check now if there are other incomes that you have to add. Discounts received, it should be added always. On the trial balance, it is always on the credit side. Okay, discounts received. It is on the credit side, on the trial balance. I repeat, the discounts received is always on the credit side of the trial balance, but the discount allowed is on the debit side. So what happens is that it's more like the opposite of what you enter or what you understand about debit and the credit. Yeah. Um, so you add the discount received because it's an income for you. Once you receive the discount, you add. So the discount received is added here. Then if you check if you have other incomes, okay? Like you receive rent received, not rent paid. Okay, once you just find the rent, assume it is the rent paid. But if it's received, they will specify rent received. So if you have received the rent, it means that you should add the rent received here to other income. It should come here. Okay, commissions received. You receive some commissions, you should also add here on other income. Whatever income that you receive, you have to do what to add. Once you do that, you have this total amount. Okay. If you don't have them, you don't have to add them. But if you have them on the trial balance, that's how you add them. Then from this amount now, this is called the total revenue. From the total revenue, this one, you will subtract the expenses, all the expenses now. Follow the way how you're subtracting the expenses. Number one, you started with wages. Then you check wages. Are they adjusted? The wages are adjusted because you have accrued what? Accrued wages. That's why you recorded like this. Okay. The wages have got this addition because this 340 is an accrued one. Okay. Then you go to rent. Are the rent adjusted? Ask yourself. Oh, the rents are adjusted because there is a prepayment. Okay. If you find that there is rent owing, okay, or accrued rent, it means you should add here because that's an expense. But since it's a prepayment, you will do what? You will subtract here, and that is what you record. Then you come to discounts allowed. Discounts allowed now is an expense. Discounts received is the other income to you, is a receipt. But discounts are allowed is an expense. You allow a discount, an expense. It is on the debit side of the trial balance. Then the van running costs have been adjusted because there are costs owing. So you add them like that. That's the van running cost. You add them. And then you come to bad debt. Okay, bad debts are expenses. Then you come to provision for doubtful debt. This provision for doubtful debt, it was an increase. The change in doubtful debt, it was an increase. So since it was an increase, you get that change on top, and it's an what? It's an expense. But if that change is a decrease, please, you should add it to income. I should add it to income because it's a receipt to you. Then you come to depreciation now. Depreciation, the depreciation that you put in the profit and loss account, I should repeat, it's just the depreciation that occurred in that period. Okay, only in that period under concern. So therefore, the depreciation that occurred under this period was this one that we were given. And then your total, the depreciation, your total depreciation is this one. When you add 380 plus 1,250, you get what? This 1,630. Okay. So once you add now all the expenses, okay, you add all these expenses, all of them from here up to here, you have these total expenses, 38,868. You subtract from total revenue, okay? You will subtract from this total revenue here. Then you get this amount as your what? Your net profit. Therefore, your net profit is 23,937, like that. That is your net profit. So let me just re-echo on the adjustments that you make. The following are the key adjustments that you make whenever you are dealing with the financial statements. Number one, accrued expenses. Okay, accrued expenses. You should know that these are added to the expenses. Then you have prepayment. Prepayment. These are adjustments that you make. Then from prepayment, you have adjustments that ask you around what? Provision for doubtful debt. okay, or allowance for receivables, provision for doubted debt. Yeah, these are adjustments that you make. And then what else? Provision, depreciation, the adjustments around the depreciation. Okay, adjustments around the depreciation. These are they that you usually make. Okay. Okay. Any question? Do I have any question on the profit and loss account? The balance is straightforward. Any question? Yes, Mr. Shaw.
Yes, sir.
Your hand is up, sir.
Yes, I just wanted you to explain more on the provision for doubtful debt. When there is a decrease, how does it become an income? How do we receive this become an income?
Okay. Oh, all right. When you have an let me start from the increase. When you have an increase in the doubted debt, what does it mean? It means that the amount that you give up that you're not going to record will be a lot. Because once you create a doubted debt, that provision, it means you're going to say, okay, these guys are not going to pay us. You're just going to allow that to say, okay, these guys are not going to pay us this much. Okay. If you say this much will not be paid to us, let's say, for example, first you say this much, 2,500 will not be paid to us. We just put that down. It means if you are supposed to record, those guys are supposed to give you 7,000, then you say they won't give us the 2,500. No, let me use the 3,000 so that I can easily calculate. You say they are not going to give us 3,000. Take what happens. When you are recording, you will not record the 7,000. You're going to record 4,000 because you have allowed the what? The 3,000 to be a doubted debt. Okay, that is the provision. Then, when you record this amount, now let me comment on what if this provision now increases. Okay, when the provision for this one increases, this is what will happen. Once you increase this amount, like that, the amount that you're doubting, maybe to again 4,000. Okay, it means now what you will record that you have will be just what? 3,000 from debtors. You will now just be expecting only 3,000 from your debtors. That's why you see that decrease. Okay, it's a reduction. So that's why it's an expense. We call it an expense. But if it increases, if it reduces, check it now. It's reducing from 4,000. It has reduced to what? To 2,000. Once it reduces to 2,000, it means you will record what? 5,000, right? You see now, you are recording a gain. There is a gain. So that's why we always regard the decrease in provision for doubted debt as a gain. Did you get that?
Yes, thank you.
Oh, okay. Any other question from anyone? Oh, all right. Then when it comes to the issue of the balance sheet, I'm sure you're now conversant with the issue of the balance sheet, right? The balance sheet to you shall not give you challenges. It's straightforward. Okay, but here is the format that I want you to follow under balance sheet. Not this one. I want to comment on that one that I gave you. Number one, we said that your balance sheet will be given, will be starting with what? With the fixed assets. Okay, the fixed assets are also called non-current assets. You have furniture, then you will less the depreciation. Okay, from furniture minus the depreciation for furniture. We had been given that the depreciation for furniture was what? 3,000 Oh, 380. Then the net book value is what? The net book value is 2,520. Similarly, for delivery van, once you subtract the depreciation, the net book value is 2,500. So the total fixed assets are what? 5,000 and what? And 20. Those are total fixed assets. Now observe what is happening. What I want you to do now, following the format that we said last time, we said we want to do this format where assets are equal to what? To capital plus what? Plus the liability. Assets should always be equal to capital plus liability. So liability. Okay. So therefore, we have found fixed assets. We just need now the total for current assets. So we come to the current assets. What do we have under current assets? We have stock. Okay. We have stock. From the stock that we have, what do we have? We have the debtors, right? The debtors. The debtors are also called the accounts receivable, okay? The accounts receivable. Now, what you do is once you have the provision for doubtful debt or allowance for what? For debtors, you should subtract, okay? Subtract the provision for doubtful debt. Now observe, check the amount that you are subtracting. This is the accumulative what? Provision for doubtful debt, not that increase. Remember that the provision for doubtful debt that you had on the adjustment was just 91. That 91 was just for that period, okay? But why did you write why do you write 491? It's because of this change. Observe that there was provision for doubtful debt in the what? In the balance sheet, okay? Provision for doubtful debt in the balance sheet. Where was it? Okay, here is our balance sheet. The provision for doubtful debt was what? Was for what? 405, okay? 405 from the other period. Now, since we are dealing with the balance sheet where we are totaling up everything, we will add also this provision for this new for this new period, which is the 91. Once you add this, you have 6, 9, and 4. 496 should be 496, right? 496. So this 496, that will be the what? This is the 496 that you are seeing now. 496, that is the provision for doubtful debt that you're going to subtract from the debtors. I'll repeat, whether you have accounts for receivable, it's the same thing. From the accounts receivable, you are going to subtract the provision or allowance for receivables, okay? Allowance for receivable or account provision for doubtful debt. You're going to subtract it, but which one do you subtract? You subtract the accumulative one. The one from the balance, from the trial balance plus that one on the adjustment which occurred in that period. You add them. Once you subtract that, what you remain with is 11,820 as what? As your what? As the outstanding debtors. This is what you are expecting from the debtors now. Because of this provision, it was supposed to be 12,316. But since you have allowed a provision, that's why it is reduced. That's how much you record. Then you should also add the prepayment. Prepayment, we said those are assets. We had to pay rent in advance. So that's why we had the two sets, the prepayment, cash at bank and cash at hand. When we add all that, we have 18,000 800 and what? 74. 18,874. So these are the total artists. What we do now is this. Following this, we want to total the assets. This is current asset. Okay, this is total current asset. You add to this fixed asset. Okay, current assets plus these fixed assets. So you say 18,000. This 18,000 of ours plus what? Plus this 5,000 total fixed assets. What do we get as the total assets now? It will give us total assets. What do we get? 18,874 plus 5,020. What do we have as total assets? 498 13 2. 23,894 as the total asset. Okay, 23,894 as the what? As the total asset. This should be equal to capital plus liability. Now check. We're going to do capital. Capital. Let's do our capital. Our capital is here. Financed by, and we less drawing. Our capital is 11,400. 11,400 plus what? The net what? The net profit. Okay. We will add the net profit. We'll add the net profit, and our net profit is this one. Okay. So the sum that we have is 35,337, which is the sum of capital plus net what? Net profit. Then you will less the drawings. Less the what? The drawings. Okay. From this 35, what is there? From 35,337 minus what? Minus the drawing, which is the 17,100 kwacha. 17,100 kwacha. We have 7. We have 3, 2. This is 15 minus 7. What is 15 minus 7? 15 minus 7 is what? 9, right? Is it 9 or 8?
It's 8.
Sorry?
8.
It's 8. Then here we had remained with 2. 2 minus 1 is 1. So I have 18,237 as capital. Okay. This is your capital. Okay, 18,237, which is, it was already written here. So that is your capital, okay? Total what? Total capital. Our capital is 18,237. What do we need to add now? Liability. Okay? We have to less what? Liability. So we can start with the, let's start with the, which one? Current liabilities. We can start with non-current if you have. Do we have non-current liabilities? Non-current liabilities are things like loans. Non-current liabilities, what do we have? There is no loan, right? We never had loans. So we don't have non-current liabilities. So we just go direct to current liabilities. On current liabilities, we have creditors, right?
Yes.
Then we have expenses owing. The expenses owing include the salaries owing, that those are accrued salaries and wages, plus the van running costs owing. Okay, those are expenses. You write it. You include all the expenses, okay? All the expenses, you know the expenses. This time around, you know expenses, all the expenses, okay? Once you record all the expenses here, you total them as the current expenses. You total them up. And the total sum of the expenses is what? 5,657. So 5,657. Can you add this? Can you add this right side if it is equal to the left side? 18,237 plus 5,000. I'm saying 18,237 plus 5,605 7.
It's the
7
same.
plus 7 is 14. Remember 1. 8 plus 1, 9. This will be 8. 13 and 2. So you've seen that, see, the right side is now equal to what? To the left side. So we are trying to obey this equation. This is the format that I talked about last time, which is not even hectic. It's very straightforward, where you just sum current assets, then you do for capital, then in liability. Hello, any question? Hello? It's equal. It's balancing. Maybe someone is asking about this format. Which format is this? I remember commenting on it last time, but let me just show you the format of the balance sheet that I'm now using, so that you don't just get confused. I don't confuse people because I'm never supposed to do that. This is the balance sheet that I'm talking about. Have you seen it?
Yes.
This is the balance sheet that I'm talking about. This is the format I was using. Okay, where I just do non-current assets, those were fixed assets. You add them here. Then you come to current assets, very straightforward. You add them here. Then you just add together the current assets plus the non-current assets. You have this as the total assets. Once you're done with that, you come to liability now, capital and liability. First, you start with liabilities. You do all the liabilities here. On capital, you start with capital, then plus the capital introduced. If you have any capital that you have introduced, you record capital introduced, you add the, if you have capital introduced along the way, you add here to capital, okay? Then you also add the net profit. You less the drawing, you have this amount. This is your total capital. Then you come to liabilities. You start with non-current liabilities, okay? Such as here you had the loan. So there was this amount. You sum all the current liabilities. These are current liabilities. Accounts payable, okay? Accounts payable, those are creditors. Creditors, okay? In other literature, you find them like that. Bank overdraft, taxation payable, accrued expenses, or expenses owing if you want. Once you do all that, you add, this is total current assets. You add to this total non-current assets. You find that they are equal, right? You will find that this will be equal to this one. So this is the format that I was showing you. Is that clear?
Yes.
It is that straightforward. So any question from anyone? Anyone is free to ask a question. Uh, okay. Let me do this now. Let me just check your assignment that you had in financial statement. Assignment 1. Yeah, this is the assignment that you had now. Let me just pass a comment on it as well so that, yeah, we can define its financial statement. This is the question that you had, assignment number 1. The due date was March for the same this year, right? So this was the question. This was your question. Pandamano is a sole proprietor trading as a mano. So the trial balance, yeah. This is a trial balance that you had, and the following adjustments were to do what? To be made. Then you needed to prepare the financial statement. Now, I already said this last time. Once they just open that financial statement, it means you have to do both the profit and loss account and the what? And the, in short, you have to do the income statement and the balance sheet, which is the statement of financial position. That's how it is. But sometimes they can specify, can you do the income statement? Income statement simply means the trading account and the profit and loss account. When you combine them together, you make an income statement. Okay, so let's start with this. You start by discussing where these go first. The trading, the advertising, is it an expense or what? Advertising is an expense. It goes in the profit and loss account. The bank is what? It's an asset. It goes in the balance sheet. Then the loan goes in the balance sheet, right? It's a long, it's a fixed, it's a liability. This one, a long-term liability. Okay, bank interest is an expense. Capital goes in the what? Bank interest is an expense. It goes in the profit and loss account. Capital goes in the balance sheet. Capital introduced, this is the one I was talking about. It also goes in the balance sheet.
You said the
Pay
bank loan.
attention. The bank loan, it goes in the balance sheet.
Oh,
Yeah,
okay.
it's a liability. It's a long-term liability. And carriage outward goes where? In the expenses, right? So it goes in the profit and loss account. Computing expenses, they go in the profit and loss account. The payables, those are creditors, right? They go in the balance sheet. Discounts received. If you receive discount, it goes in the what? In the trading account. Okay. It goes in the trading account. You add this. I'm just talking about this trading account. Drawings go in the balance sheet. Fixtures, those are assets. They go in the balance sheet. Power, electricity is an expense. It goes in the profit and loss account. Profit and loss account. Allowance for receivables now is an expense. I just said that you treat it's the same way how you treat the provision for doubtful debt. Okay, so loss and sales go in the trading account. Purchases go in the trading account. Salaries go in the profit and loss account because these are expenses. Then you go to accumulated depreciation. Now, this is the depreciation from the other year, okay? It goes in the balance sheet. We will show you now how you, it goes in the balance sheet. You will see it how where you subtract it in the balance sheet. And the inventories, but there is a difference between this depreciation. This is the depreciation as at the beginning of the year. So it came from the other period. Then there will be the depreciation that you calculate, like which one? This one. The depreciation as at first December. Now this is the depreciation that just occurred within the period. This is the one that goes in the profit and loss account. But this one, the accumulated depreciation, this one, it is from 1 January. Like it came from the other period. So since it came from the other period, it should be recorded. It shouldn't be recorded as what? It should be recorded in the balance sheet. Okay, not in the profit and loss what? Not in the profit and loss account. Is that clear?
Yes.
Oh. Do I have any question from anyone first before I can proceed analyzing the question with you? Okay. Yeah. So I'm still commenting on depreciation because these are the common adjustments you will find. I said the common adjustments you find, there are those about depreciation, the adjustments about provision for doubtful debt or allowance for receivables, and the other adjustments therefore about what? They're about to accrue the expenses and the prepayment. Those prepayments. Yeah, those are common ones. So this one, yeah, goes in the what? In the profit and loss account because it is regarded under that period. But this one that you came with when you started the period, please, it goes in the balance sheet. You will see where we record it and its right position. Then we come to which one? The inventory. The inventory as 1 January. This is the opening stock, right? When you started, you just started the year. It's the opening stock. You open with that, and you know that opening stock goes in the trading what? In the trading account, according to the previous video class. So if you missed the last class, you can still do well to go through the last class. It is there, either on YouTube or you can still follow it. The link is there. It's still there. It's still active. Yeah, so that you can just get this clearly. Okay, now, before we start now doing the right thing, before you can start doing what you're doing, you have to check the adjustments that go in the what? In the trading account. I said the trading account ends just before expenses. Okay, that's where it ends. So now check. We have the inventory. This is the closing inventory. The inventory I said 1 December. Yeah, this is the closing inventory. The closing inventory goes in the trading account. So this one will be accounted for. Very important. Which other adjustment do you need to go with? You need to look for provision for doubtful debt or allowance for receivables. Okay, so that you see whether it's an increase or decrease. Very important. So it is the adjustment number 5, right? The allowance for receivables is 5% of the receivables. So where are our receivables? You go to our receivables. What? Our receivables is 60,000. So you calculate 5% of 60,000. 5% of that is 0.5 or 0.05 times the 60,000. And what do you get as the allowance for receivables?
3,000.
You get the 3 what? 3,000. So you take now this 3,000. This is what you do now. You compare it. Follow nicely, please. We beg you in the name of God to follow for the sake of peace in the long run. Let's do this. So you've seen your allowance for receivable is 3,000. You have to take whether it increased or it did not what increase. So you will this receivable of yours minus what? Minus the allowance for receivable you have already. It's here. I'm teaching. Yeah. So you have 3,000 minus what? 4,000. You've seen that, right?
Yes.
It is negative what? Negative 1,000, which shows that this was a what? It was a reduction, isn't it?
Yes.
Was it an increase in the doubtful debt, or was it an increase in the allowance for receivable, or it was a decrease?
Decrease.
It was a decrease, right? And once you have a decrease in the allowance for receivables, what do? You will add it to what? To other incomes, isn't it?
Yes. Yes.
Did I just say that? I said you have to do what? Once you see that it's a decrease, it's a negative value type. It's a decrease. You add it in the what? You add it among other incomes, okay, in the trading account. Immediately after gross profit, you will add this reduction in the allowance for what? For receivables. Clear?
Yes.
But if it is the increase, if you find that this number is positive here, okay, this number is positive. For example, it was positive 1,000. This is an expense. So you go and do what? Add this to expenses. And it will be increased because it's positive. It means it will be an increase. So you say increase in the what? Allowance for receivables 1,000 as an expense now. I think I just said that previously. You are following. So now this is how you analyze your what? Your statement. After that, now you can regard these other what? These other adjustments before you can. I said the first one is just to check, do you have the closing stock, opening stock, and the allowance for receivable? Only those adjustments that affect the trading account. Yes. So we go now to number 2. The second one is prepayment for rent. You know prepayment, I'm just talking about prepayment. I said prepayments are what? Are subtracted. Okay. Prepayments are always subtracted, and these, when you go to the balance sheet, they are what? They are current assets, right? The prepayments are current assets in the balance sheet. But when you are dealing with in the profit and loss account, you should subtract this from rent. So your rent is what? How much was your rent? Rent. Okay, rent is here. 12,000, right?
Yes.
So you say 12,000 minus 4,000. This 80,000, that's what you are going to record under rent. That's outstanding rent because you had already prepaid. You paid in advance. Accrued what? Accrued the power. Okay, this is an expense. These are accrued expenses. You just add this, just as we did in the previous study. Add the accrued what? Expenses. From the accrued power, you add this 2,000 to power. Power is here, 8,000. So you say 8,000 plus what? Plus this 2 pin, 2,000, and you add. You have that 10,000 as power. That's what you're going to record. Where else now? Number 4, the computer crashed in December 2021, which is the month that you are closing there. Then an engineer gave an estimate of 1,000 to repair the what? The computer, which this person accepted. The engineer repaired the computer, but has not yet submitted the invoice. Okay, it is like this. You are closing the year to like the financial year, of course, in December. For example, on Friday, this coming, today is what? Today is, oh, it's Sunday. You're closing it on Wednesday. You're closing your financial year in Wednesday. Then today, your computer has been crashed. You have a problem. You ask the engineer says, I think this one can take a 1,000 to repair it. Okay. Then you accept that, okay, it's fine, you can repair. The engineer repairs it, but the engineer has not submitted the invoice, meaning has not asked it for that money. In short, you have not paid. Okay. Then where do you record that amount? This one is an accrued expense. Okay. It's an accrued expense. You are going to pay for this one, but you haven't just paid for it. So you know what to do to accrued expenses. So you go to computer expenses. These are computers. Computing expenses are here, right? 20,000. You will add this what? This is 1,000 to this to the computing expenses. Hope that is clear. The computing expenses, you add this as an accrued expense. Then you come to carriage what? Carriage outward. You know how to deal with carriage outward. I said that carriage outward is what? It's an expense. Whereas carriage inward, you add that one to in the trading account.
Mm-hmm.
Okay. Number 5, adjustment number 5. Depreciation of 30,000 is to be provided for the year ended. Now, this is the depreciation that occurred in the what? In the period. So this is the depreciation that I said it goes in the what? In the profit and loss account as an expense. Then when you're writing in a balance sheet, you need total depreciation. So you will add the depreciation for which are these? These are fixtures, right? These are fixtures.
Yes.
The depreciation that you have to record when you are recording in the balance sheet now, you add this 30,000 here, which came from the other period, then plus this other what is, plus this 30,000, this depreciation that occurred in this period, where you have a 60,000 as the total what? The total depreciation for fixtures, okay? So that when you're finding the net book value in the balance sheet, you just subtract the cost of the asset and the cost of asset, the cost of fixtures. Where are they? Fixtures. Oh, fixtures at cost, they're here. It's 120,000. So you say 120,000 minus what? Minus this depreciation. So the net book value, which means the present value of what? Of this asset will be what? 60,000. This is what you're going to record on your balance sheet as the value of the asset, as just 60,000, because it has lost to the value of 60,000. Do I have any question on the discussion of these adjustments first before I can go to the solution? Anyone can ask.
So I've got a question.
Yes, sir.
So what you're trying to say is that in the profit and loss account, we add the 30,000 to the depreciation. That is where is that word? Okay, just come again on the depreciation.
Okay, I said that you have two depreciations, right? You have this depreciation and this one. Now, you know that depreciation has two positions. You can find the depreciation in the profit and loss account and in the balance sheet. Now, in the profit and loss account, you just record the depreciation that has occurred in that period under concern. Your period under concern starts from 1 January to what? To 31st December 2021. So you just want this depreciation that occurred here. That's the one you record in the what? in the balance sheet, and you are told that that depreciation, okay, number 5, additional information number 5, depreciation of 30,000 is to be provided for the year ended 31st what? December 2021, meaning as when you close the year, the financial year, this is the new depreciation you had. So this is the depreciation that you record in the profit and loss what? Loss account. But when you go to the balance sheet, remember in the balance sheet, you want to know now, assess the value of the assets, right? To be specific, the fixed assets. You have fixed assets like fixtures here. You will not record 120,000 for fixtures, no, because it is cost of that asset minus the depreciation for the fixtures. Then the net book value is what you're going to record. So you say, what is the cost for fixtures? It's 120,000. What is the depreciation now as you are closing? You add now the depreciation that you have of this asset from the time when it was bought. It was bought at 120,000, but by 1st January 2021, it had already lost the value of what? 30,000 of this 30,000. It had already lost this value. So you add this value which is it had lost plus this value it has lost from 1 January to 31st December 2021. This one you add it forms what? 60,000 now as the total what? Total depreciation. Once you subtract that, the net book value now, which is the value of the asset now as it stands, it will be what? This difference, which is 60,000. Does that help?
Yes, clear now.
Okay. Any other question from anyone? Oh, it seems there is no question, sir. You can proceed. So this is your what? This is the profit and loss account, which is the income statement. This is your income statement. So this person is income statement for the year ended. The title is very, very important now. This is the format of the title. Always the name of the company, name of the what? Of the company. And this was a mistake. It was not Panda Mano. The person was trading as Mano. So it is supposed to be Amano, something like Amano as the name of the company. From the name of the company, you come to the name of the statement. Name of what? Statement. Is it a balance sheet or an income statement? Then you go to the what? To the year, the period, then the year, which is for the year ended. Always for the year ended, you write the date like that. Hope that is clear now. The title is always very important. It is the same thing that I was saying now. Sales, you have your sales. You have no sales return. You go to opening inventory. Yeah, you list purchases. Add purchases. Then you find that the cost of goods available now will be that minus the closing stock. You have your gross profit. You add other incomes. Check that under other incomes you have what? Discounts received and reduction in the allowance for receivable. And then once you add that, you have total income. This is your total income. You list your expenses, right? The following are expenses: advertising, bank interest, carried outward, computing expenses are accrued, right? They are added. You add the accrued expenses. Even on power, you have an accrued expense. On your rent, you have a prepayment. On salary, just like that, you don't have any accrual. Fixtures, depreciation. Now, this is just the 30,000 I was talking about. That one which just occurred in that period. total expenses to be subtracted from here. You have 98,000 as your what? Your net profit. Clear?
Yeah.
This is clear, so you can proceed. Then you go to what else? The balance sheet now. The balance sheet, yeah. Just as I said on the balance sheet, I said you start with fixed assets. You have fixtures, right? Fixtures, you just write the cost minus the total depreciation now. This is the depreciation I was talking about. You remain with net book value of 60,000. Current assets are inventories, receivables, which are debtors. You should do subtract that allowance for receivables. Okay, the 3,000. I said that you always reduce that from provision for doubtful debts, right? Then you
Yeah.
have rent prepaid. You have the bank, just like that. That's your total what? Total assets. Then in this format, from this format, I did the other format. Okay, this one was the other format, but you can follow that same format I've shown you. That one is the most straightforward. But even this one, you can still get it. You let's see current liabilities. All the current liabilities are subtracted. You have that same amount as the net asset. Now this one is this is the format. Assets minus liabilities should be equal to what? To capital. Okay, this is the other form of that equation now. It's the other form of that equation. Okay, you have net assets because the assets minus liabilities is called net assets. Then you add capital. Your capital plus capital finance, additional capital, that capital you added, plus the net profit. Then you less your what? Your drawing, just like that. Then you add the long-term what? Liabilities. Long-term liabilities, you just had a bank loan. What you remain is capital or equity, capital employed or your what? Your equity like this. So you find that your equity, which is it will be just basically the sum of all these. You sum them, it will be basically equal to the net asset. Okay. Your capital employed, capital is now equal to this part, this other side, the net asset. So which is again the same thing. It is agreeing to that equation. So any question? All right. So what we are going to do is this, since there is no question, let me stop recording.